Risk. Risk is the most important concept when you're trading, hands down. You have to understand this when you're trading, because if you don't, you're executing blindly. It's that simple. You're taking trades and you don't know how much money you're risking. You're executing blindly. And that's how you end up blowing an account, right? And I know that no one's blown an account on account of me because I show them this. So risk is the most important concept when you're trading. Every position that you take, I recommend that you calculate your risk. You want to know how much money you're going to lose for every trade you take, and you should be consistent in that amount that you're losing until you hit a target amount in the profit that you want to make on your account balance. All right, so let's get into it. Disclaimer. Risk management. The most important part of managing any position is managing the risk involved. Calculated and defined risks are controlled risks. Objectively, every trader wants to make the most profit with the least risk in the shortest amount of time. Depending on the trader's frequency of trading and profitability consistency, risk management styles will vary for every individual. Although styles can vary, there are key factors we can control that we must always be aware of, and these are the size of the position that we're taking. This is the amount of money that we're risking in the trade that we're taking. The time, how much time we're spending in the position, and frequency. How many positions are you taking, right? So how many trades do you have? So first thing, lot size. This is a standardized image, a standardized diagram we got right here. And it basically shows you the amount that you'll be making per pip, and a standard lot, mini lot, micro lot, nano lot. So a 1.0, a standard lot, it's $10 per pip, a 0.1, $1 per pip, a 0.01, 10 cents per pip, which is, I'm pretty sure that's the smallest lot size I've ever seen on MetaTrader for. I'm not sure if somebody's broker offers smaller lot sizes. Yeah, so, and then you got a nano lot, which is a penny per pip. And then your lot size, if that was a 2.0, you'd be making $20 per pip. And taking a look at our trading execution window right here, you can see our lot size, where on the minus side, if you touch and input those values, they will go down at a value of 0.1 or a 0.01, and then same on the plus side. And then if you tap the white number in the middle, you can actually input your own value instead of just tapping numbers until you get to where you want to be. So every trade that's placed has a lot size. Traders need to actually calculate what their lot size is for the amount that they're willing to risk, right? You don't want to trade based off of like, oh, I have $100 account, so I'm going to trade a maximum volume of 0.1 lots on my account. It's not how you trade. You want to calculate the risk you have for every position that you take, and you want to know what your margin percentage level is, right? You want to know when you're on margin. You want to know how much it costs for you to actually be in these trades that you're taking. All this information really determines the risk. What is the value of your money in your account when you're trading, right? This is why people blow up accounts, because they don't actually understand, what they're making on their trades, the value of their trades. So margin, your leverage. This is a fractional increase you can trade from the amount of capital you have based off the leverage your broker provides. So really what this means, if you have $1 in your account, your broker will trade at 100 times greater than the value it actually is. So 100 to 1 leverage, that's what that is, right? 500 to 1 leverage, you're going to have that $1 traded at $500. $500, 500 times greater than the value that it actually is. And the reason why leverage is so important, the better your leverage is, the higher your leverage is, the better your margin requirement will be. So with 50 to 1 leverage, you can see here on a standard lot size traded on a $5,000 account, that's going to be 44% of your account. It's going to be $2,236, right? And then on 100 to 1 leverage, your margin requirement will be less, and so on and so on. So the better your leverage is, the better your margin requirements will be. The more your leverage is, the less your leverage is, the more your margin requirement will be. The higher your leverage is, the less your margin requirement will be. And just going in right off bat, basically if you're making more money on your trades because you have higher leverage, it also means your risk is increased as well. So you can lose more money. Leverage is good in the sense it allows you to finesse a small amount of money like it's a large amount of money. You can trade $100 worth of capital like it's $500 worth of capital, right? And this is something that can really just make a huge impact on, funds in a very small amount of time. When you start to understand how these concepts could actually be applied. If you're trading something that's extremely volatile with a lot of leverage and a low margin requirement, that's something you can make a lot of money off of, right? So start paying attention to these things. So finding the PIP, how do we locate the PIP? For Forex pairs, the PIP value, right, on most pairs will be the fourth number after the decimal place, which is the 9 on the top one, right? So there we go right there. And then for Japanese pairs, the PIP value will be the second number after the decimal place. And when you're looking at it on your trading window on a MetaTrader 4, the PIP value for Forex pairs will always be the number before the subscript value, right? So that's always going to be the number before the subscript value. And you need to know how to locate your PIP so you can do the math to figure out the distance between certain prices, right? When we subtract these values from one another, we'll be able to determine how many pips are in between certain areas. And when you are able to determine how many pips are in a certain area, you can figure out what your lot size will be for a trade, right, for a particular position. So PIP is the acronym for point and percentage. Small unit of measurement used to calculate the change in price. The location of the PIP could vary for whatever instrument you're trading. So we just went over Forex pairs. We always have to be aware of the PIP location. So for metals, energies, indices, cryptocurrencies, commodities, stocks, we need to be aware of where the PIP location is. It's not going to be the same as Forex pairs. So there are a number of different ways to do that. They have applications like Stinu, STINU, where you could calculate lot size and PIP values. And then they have your ruler. You can use the ruler on MetaTrader 4. You can use the ruler on TradingView, which basically you start at one price and then you measure to another price and it'll tell you your pips. On TradingView, they have a long and short position window that I could show you guys as well. But basically, using a ruler, it'll just tell you what the pip value is right off the bat. But another way to do it is with a demo account, right? So you open up a demo account, you could take a mock trade with the 0.01 lot size. And we know with the 0.01 lot size, that's 10 cents per pip. And whatever value that trade is at could really make evident, what the pip value is in your quote price. So $4 of profit on a 0.01 lot size is 40 pips, right? And another way to also determine where the pip is by looking at the spread. So when we do any risk or reward calculations, we have to understand the pip value and lot size. After that, we have to know where the entry, stop loss, and target prices are. All right, so entry price. Entry price is the point where we enter in our position. That's the point where you're going to get into your trade. Stop loss is the point where you exit the trade for a loss, where you would exit the trade losing capital. The space between your entry and your stop loss is the risk zone, right? And we need to calculate the pips in that zone to figure out what our lot size will be for any particular trade that we take. Your targets are the price points where you exit the position for a profit, where you will gain capital. The space between your targets and your entry is the reward zone. Risk and reward, the ratio between your risk area and your reward area will tell you the profitability risk that you will have on your trade, right? So a 1 to 3 trade, a 1 to 5 trade, we always want our risk to be significantly smaller than our reward. Risk calculation. So this is the golden equation. This is like all you need to be consistent in the amount that you risk for every trade that you take. So the dollar amount that you're willing to risk divided by the pips in your stop loss will give you the dollar amount that you're making per pip. When you know how much you're making per pip, you can then determine your lot size really easily by multiplying that value by 0.1. So a profitable trader is always going to know how much they're risking. That way, they can minimize their risk. They can be consistent in the amount that they're losing, right? If you're consistent in the amount that you're losing and you're always profiting more on your targets, let's say on a 1 to 3, that first target that you hit is going to be the size of your stop loss. That second target, you just made twice as much as you would have lost in that trade. So we want to be consistent in our risk amounts so those numbers can add up when we're taking 1 to 3, 1 to 4s, 1 to 5s, consistent trades that are always great risk to reward ratios. And to calculate the pips in your stop loss, you're going to always subtract either your stop loss from your entry price in a sell or your entry price from your stop loss price in a buy. So this is an actual example. So you can see our entry prices and our stop loss prices. And this is a sell. So we took that higher number, which was the stop loss, and we subtracted the entry price, right? And we got 0.00637. That's 63.7 pips in that zone. And in this example, we wanted to risk $20. So 20 divided by 63.7 equals 0.31399, right? And what this means is you're making 31 cents per pip. 31 cents per pip. And in order to figure out what our lot size is, we're going to multiply that 0.31399 value by 0.1. And when we multiply that by 0.1, we get 0.031399. And looking at the diagram that I showed a couple slides ago, we know that the smallest lot size we could trade on MetaTrader 4 is a micro, and that will round to 0.03. So we would be making 30 cents per pip on this position if we wanted to risk $20 with a 63.7 risk zone in terms of our pips, right? 63.7 pips. And our reward zone is 241.8 pips, right? So 30 cents times 241.8 pips, pretty sure that's 70 something dollars, right? Pretty good, right? Risk $20 to make $70. Short-term and long-term frequency. So the number of trades that you're taking, right? We want to be aware of the amount of trades that we're taking. The frequency of the trades that you're in will really determine the amount of exposure that you can have. So if you're in too many trades at once without making those trades risk-free, that means you still have capital up for grabs. So a short-term trader is somebody who's in multiple positions at once, right? Will be in and out of positions in the same day. We want to have a maximum risk exposure of 10% at any given time. And something that comes in with being a short-term trader, more than likely, you're going to be making a lot of your positions break even. You're going to be moving your stop loss into profit a lot, right? And the reason why we do that is so we could open up more positions. So the number of trades that you're in will change once you have a position that breaks into profit and you move your stop loss into profit. Now you have another trade available. So this is for a long-term trader or a short-term trader. Long-term traders, you can have more trades, right? And I would recommend between 1% and 2%, depending on, the size of the trades that you're taking as far as like stop loss and target areas, right? How long you'll be in that position. Your maximum risk exposure, 20%, because you're holding these trades over a longer period of time. You have more time to analyze and decide whether or not you still want to hold that position. Your margin per trade for both, we want to make sure we don't go over 33%, right? And margin per trade is basically how much capital is required for you to enter into that position and your overall margin exposure, right? We don't want to expose a certain amount of capital, right? And when you're trading and your margin is overexposed, and you won't be able to take any more trades. So we have to be aware of our overall margin exposure so we can actually close trades if we see other opportunities that we want to get into. And for long-term traders, that number could be bigger. Like I said, we're holding these positions. We have more time to analyze and decide what we're going to do as we're trading. So short-term, long-term, frequency of your trades. Another thing to note too, we go over this in supply and demand. Candlesticks. When candlesticks form in a zone, the amount of time that a trade spends at your entry area inside your risk area, the amount of time that a trade takes to leave a level can also determine whether or not you want to stay in that position. So frequency plays out in a couple of different ways. The amount of trades you have, right? The amount of risk exposure you have, your margin exposure. So these are things we want to be aware of with frequency. And then also what I just said a moment ago. So risk factors, where to place your stop loss, what is position risk to reward, how many positions can be traded at one time, what is the position size based off the risk amount, what should be my maximum loss limit for the day of the week, what should be my maximum loss limit for the day or the week, right? How do I secure profits? Breaking even, trailing stop, and the technical stop, right? And we go over that in the stop loss section. Those are all different ways that we can secure profit, make sure we're holding our bread. And then control risk factors. You want to make sure you risk no more than 1 to 2% of your capital on any single trade. Take multiple positions on one trade without exceeding your set risk limits, right? So when I say that, on that 0.03 lot size, we could enter into that trade at 3 different positions, right? Or we could take 3 different positions at once and have each position chasing a different target, TP1, TP2, TP3. And the purpose of doing that is so that we can spread out our risk, spread out our exposure on our trade, and we can secure at multiple levels. That way we can always make sure we're making money. It might not break out and hit our final target, but that way we could be securing profits still along the way. On daily loss, take no more than a 2 to 3% day loss. Live to trade another day, right? That's this game. You always want to be available for more opportunity. If you're losing a lot, don't keep trading. But another thing to always keep in consideration is if you're calculating your risk, you'll be able to afford to take a couple of losses. So calculate and use proper position size for each trade. Take opportunities with a minimum of 1 to 3 risk to reward ratio. So starting off, coming out the gate, as a new trader, I recommend 1 to 3. The next slide is going to show why. Stay profitable when your win ratio is below 50%, right? So with the 1 to 3 risk to reward ratio, with the win ratio below 50%, you can still be making money, right? If you're losing more than half of your trades, then you still can be making money taking 1 to 3 risk to reward ratio trades. And this is why. So maintaining consistency in your dollar risk amounts and risk to reward ratios will allow for capital growth with the winning percentage below 50. So if you're losing more than half the time, if you're winning 30% of the time, right? And this is in this example here, you're winning 30% of the time for all of them. You have a $5,000 account. We're risking 2% on every trade. So that's $100 of risk on every single trade. Your win and loss ratio, 30%. So we win 30% of the time. Your risk to reward for the first one, 1 to 3. Right? So for the winning trades, you win $300. For losing trades, you lose $100. So we win 3 trades, that's $900. Right? Because your winning trades are $300. We lose 7 trades, that's $700. You're still profitable. On 1 to 4, you would have made $1,200 because your winning trades make $400. They're 4 times greater than your risk zone. And you would have lost $700 because we lose 70% of the time. And you still would have been profitable $500. If you were taking 1 to 2 trades and you won 30% of the time, and your winning trades made $200, so that means we won 3 trades, $600, and we lost 7 trades, $700. You would have lost $100. So coming out the gate, look for positions that are 1 to 3. This is how you could practice, right? Practice trading with, not a lot of capital, not capital that'll hurt you if you lose it, coming right out the gate, but make sure you're consistent with your risk to reward ratios and you're consistent in the amount that you're risking too as well. Because if I was risking $10 for every trade and then I decide, okay, I'm going to risk $20 for this one trade and I lose that trade, now I'm down 2 trades instead of, just 1. You feel me? And also with that being said as well, breaking even. So if I won 3 times taking 1 to 3, if I lost 3 times taking 1 to 3 risk to reward ratio trades and I won once, I would break even. And only if I was consistent in the dollar amount that I was risking. So if the dollar amount that I was risking was inconsistent, then my 1 to 3 wouldn't really matter. This diagram that I'm showing you wouldn't really matter because my winning trades and my losing trades wouldn't be the same when they actually hit target. So we have to make sure we're consistent in the amounts that we're risking. So that way, all our losses should always be the same size. Our wins will vary, but our wins will be greater than our losses. You don't want to have L's that are big some days and smaller other days, right? If you think, I'm about to bust trades today, and then, that doesn't happen, you can't trade tomorrow. This is why we're consistent in our dollar risk amounts, right? In calculating our lot sizes.